Why the world's two biggest economies are meeting in Kuala Lumpur this week, and how you might feel the consequences from your smartphone's price tag to the stock market. Stay with us. The United States and China have launched urgent trade talks in Malaysia to avoid a full-blown trade war and to pave the way for a face-to-face meeting between President Trump and President Xi Jinping next week. Let's break down what's at stake, what's happened so far, and what it could mean for you. Timeline. Facts. What happened? On October 23rd, China confirmed that high-level trade talks would be held in Kuala Lumpur from October 24th. On October 24th, U.S. officials, including Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer, arrived in Malaysia to meet China's Vice Premier Hu Lifeng in a bid to prevent a trade war escalation. China recently expanded export controls on rare earth magnets and minerals, critical inputs for electronics, EVs, defense systems. In response, the U.S. is threatening to impose 100% tariffs on certain Chinese goods starting November 1 if no deal is reached. All of this is building toward a Trump-Xi meeting scheduled for next week at the Asia-Pacific Economic Cooperation, or APEC Summit in South Korea, which could mark a turning point in the trade relationship. First, the context. China is dominant in rare earths, the materials behind many modern technologies, smartphones, EV motors, military hardware. China's moves to restrict exports of these is a major leverage point. On the U.S. side, the Trump administration has ramped up tariffs and export controls on China, targeting technology and critical inputs, which means trade is no longer only about goods, it's about tech, supply chains, national security. Why Malaysia? Because the talks are taking place on the sidelines of the ASEAN summit, a neutral location, and because both sides want to keep the next step, the Trump-Xi meeting, alive, rather than let negotiations collapse. Important nuance. Neither side seems ready to walk back to January, pre-escalation terms. Instead, what is likely is modest relief, maybe a suspension of new tariffs, maybe China committing to U.S. soybean purchases, maybe the U.S. easing tech export rules little by little rather than big deal of the century. But there are risks. If talks fail, the U.S. goes ahead with 100% tariffs, China keeps its rare earth controls, global supply chains look shaky, markets might spook. Implications: what it means for markets and consumers. For the markets, tariff escalation tends to spook global stock markets, especially if it threatens key economies. Rare earth restrictions could push up tech hardware production costs, chips, EVs. That in turn can squeeze margins for companies, raising prices for consumers and reducing earnings for investors. If China agrees to buy more U.S. soybeans or Boeing planes, that could benefit certain U.S. sectors, agribusiness, aerospace, and ease market anxiety. However, if the U.S. adds more firms to its export blacklist, which it's already doing, then tech supply chains, especially semiconductor and AI firms, could suffer. For consumers, if tariffs stay high or go higher, many consumer goods made in China could become costlier: electronics, appliances, clothing. If rare earth supplies are restricted, the cost of EV motors or high-performance chips might rise. You might notice more expensive phones, slower upgrade cycles, or less choice. For U.S. farmers, China has in the past agreed to buy U.S. soybeans as part of trade deals. If this happens again, farm incomes might recover, but if it fails, there could be further slump in farm exports. for global supply chains and strategy. Companies might increasingly diversify away from China to avoid risk of export controls or tariffs, shifting manufacturing to Vietnam, India, Mexico, Malaysia. That transition costs money and time, which could mean higher costs for consumers and transitional disruption. Also, geopolitically, countries in Southeast Asia, for example, Malaysia or Vietnam, are in a tricky spot. They don't want to pick sides, but may benefit if they become alternative manufacturing hubs. Here's what to keep your eye on in coming days or weeks. Will a formal Trump-Xi meeting happen next week? If yes, what is the scope of any deal? Full rollback of tariffs? Unlikely. Or limited carve-outs? More likely. Will China modify its rare earth export controls, for example, raise export quotas or licenses, or allow easier access to non-Chinese firms? Will the U.S. hold off on its planned 100% tariffs on November 1 or delay them pending progress? Will China commit to buying U.S. goods, soybeans, aerospace, or open its markets further? Will global markets react positively, relief bounce, or negatively, fear of breakdown? If you are investing, keep an eye on companies tied heavily to rare earths, chip manufacturing, EV supply chains, and U.S. agribusiness. If you're a consumer, watch pricing trends in electronics and vehicles and stay alert for manufacturing shifts. The U.S.-China trade talks in Malaysia are not just diplomatic theater. They are a live test of how far both sides are willing to go to manage their rivalry, instead of escalating it. For you, this could mean higher prices, slower hardware upgrades, or new investment opportunities. If you liked this breakdown, hit subscribe, click the bell so you don't miss updates, and leave a comment below. Which sector do you think will be most impacted? Tech, agriculture, or consumers? Sources and further reading are in the description below. Thanks for watching, and I'll see you in the next video.